Welcome back. It looks as though 5-year fixed rates are on the rise. This is largely in part due to the bond market yields increasing on 5-year government bonds, and I'm going to discuss why. I'm going to talk about what the rates have gone to and what you need to do to prepare for higher interest rates. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video, and don't forget to subscribe because if you do, you'll be entered for a chance to win $5,000 when we hit 25,000 subscribers. So go ahead, click that subscribe button. It's free, it's easy, it's definitely worth it, and thank you to the 17,370 of you now that have already clicked subscribe. I appreciate each and every one of you. The definitive guide on how to manage your credit, product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss what is happening in the bond market and subsequently what has happened to 5-year fixed interest rates and what this all means and where things are going from here. So let's start first and foremost by talking about what is happening and how mortgages are priced. So what you need to know about how fixed rates are priced is that 5-year fixed mortgages, for example, are typically priced off 5-year bonds. And when 5-year bonds move, that means the cost of funds increases and therefore you see interest rates increase. Now that's assuming that the 5-year bond increased and didn't go down. If it goes down, then the price of the mortgages typically go down. And if we go ahead and we take a look here at the 5-year government bond yields, I'm going to take you in and just show you kind of what is happening over the last couple of days here. So if we go and we take a look at the 5-year government bond yield, I'm going to stretch this out to basically the last, let's call it 6 months. This puts us back to around March. And what you can see is that interest rates have basically been up and down since March of last year. If I punch this back out to year to date, what you can see is that in March, February of this year, interest rates went up substantially. Bond market prices went up substantially. We therefore saw about a 0.5% increase in 5-year fixed rates. And then things kind of just steady along here till August. And then around August 1st, we saw a big drop. We didn't see 5-year fixed rates come down. We just saw them start to come down last week. And then all of a sudden, now we're seeing in the last couple of days, these 5-year bond yields spike quite substantially. And here's the thing, right? The reason for this is that we're seeing some upward pressure in the bond market. And the question is, well, why are we seeing upward pressure in the bond market? And that comes down to what's going on in the US with the Federal Reserve Bank. And what is basically happening is the Federal Reserve is finally acknowledging that they're going to begin tapering their bond buying, much like Canada did in the last few months. And they're going to start taking some of the stimulus out of the economy, even when they expect inflation rates to be coming down. And this has a significant impact on what the expectation for interest rates are going to be. So when you think about a 5-year bond yield, what you're looking at when you look at the 5-year bond yield is the market's expectation of what interest rates are going to look like in the next 5 years. And if the expectation is that interest rates are going to remain low, then the 5-year bond yield will typically remain low. But if there starts to become expectations that the interest rates are going to go up, then the 5-year bond rate will increase accordingly. And when the 5-year bond rate increases, then so too does the actual interest rates of 5-year fixed mortgages. Now, that being said, I'm going to tell you what the interest rates went up to here, what they're going to go up to at the end of the video, so stay tuned here with me. But I want to show you basically one more little thing with respect to what's going on in the US, because it seems to be some animosity happening between the Federal Reserve and the government. So basically we have Elizabeth Warren, who is very left-leaning. She is very much in favor of higher interest rates faster and so on and so forth. She is basically saying that she doesn't believe that Jerome Powell should be nominated for a second term. She disagrees with his policies and so on and so forth. And, that's interesting because if they start to change the governor of the Federal Reserve Bank or the chairman of the Federal Reserve Bank, what could end up happening is we could see a completely different policy. And if we see a completely different policy, that could change how interest rates run all over North America. Now, here's the thing. 5-year fixed rates are changing, variable rates are not, and we still have considerable amounts of time before interest rates start to go up. Even though the Federal Reserve is taking away some of its tapering, they're taking away its bond buying program. Well, they aren't saying they're going to increase interest rates anytime soon, and they're still looking to end of 2022 to end of 2023. So it's still my belief that if you can get a variable rate mortgage for 0.5% to 3% to 1% lower than what you can get a fixed, then it still makes sense to take that variable rate mortgage, because on a $500,000 mortgage, if you're saving 0.5%, you're saving $2,500 per year. And if you're saving a full percent, you're basically saving $5,000 per year. So, if you want to learn more about my thought process and why I believe that variables are better than fixed, there's actually a chapter in my book here, The Mortgaged Millionaire, that talks about why floating is better than fixed and goes into the Mosh-Milevsky study that is basically the quintessential document when it comes to understanding variable versus fixed. I'm giving this book away right now for free. All you have to do is pay for the shipping and handling. You can go to mortgagedmillionaire.ca to get that, but there's a chapter in this specifically on why fixed rates tend to underperform variable rates, and it's really, really, really great information, more than what I could put into a little video like this. Now, when it comes to the actual interest rates themselves, I'm going to pull these up here and show you where we're at right now. So as of today, if you're looking at a 5-year fixed, you can still get them for under 2%, but some of the lenders have started to increase the rates, which means that most of them will follow. We probably have 2 or 3 days to still be able to get a 5-year fixed under 2%, at least for right now. I fully expect that we'll see 5-year fixed rates under 2% again in 2 or 3 months as the market starts to settle down from the talk of the Federal Reserve basically pulling their incentives out of the market. So I do believe that we will see under 2% rates again, but as of right now, if you want to get under 2% on a 5-year fixed, then you probably should be putting in your application and getting a rate hold as fast as you possibly can, because by the end of the week, most of the interest rates across the country on a 5-year fixed mortgage are going to be around 2.24%. The lowest rate on a discount mortgage is probably going to be about 2.09% or 2.04%. And if you're looking for a 30-year amortization, you're probably looking at the 2.29 to 2.39 range. So these 5-year fixed rates are going to go up. I still believe that variable rates are a better option for most people, but if you absolutely want a fixed rate, then make sure that you are getting your mortgage approval done quickly, your pre-approval done quickly. Don't delay, get your documents in and do whatever you can to lock this in as fast as you can, because while we may see under 2% rates again in the future, it might take till next year before we see them again. And if you're looking at purchasing in basically the next 120 days, or you have a renewal in the next 120 days, now is the time to get that fixed rate mortgage rate locked in. So that's today's video. If you found it useful, do me that favor, hit that subscribe button, hit that notification bell. Don't forget that you can go and get this book for free, just pay shipping and handling. And by the way, our Secrets to Getting the Lowest Interest Rate course, which is linked below, it is going up in price by the end of the week. There's going to be all new course information. So if you're interested in finding out how to get the lowest interest rate and how to negotiate for the best rate, whether it be with your bank or your broker or whoever else, that course is going up in price by the end of the week. It is your last opportunity to get it at the price it's at now. It's going to be revamped. When it's revamped, if you bought now, you will get the updated version. And if not, you're going to pay a little bit more for that down the road. And by the way, most of the clients, most of the people who have purchased that course have saved anywhere from a few $1,000s to $15,000 to $20,000 just by knowing what to say and when to say it with the lenders. So we'll see you on the very next video. Don't forget about that race to 25,000 subscribers, and I hope you have a good one.